Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and this is Investment Friday. We've got Brad Haines here with us today. Brad Haines, the Chief Investment Officer of Junction Wealth Strategies. Brad, what's up?
Not much. Lots of volatility in the markets and interesting events over the past week where we've had presidential debates. We've had, or at least one presidential debate. We've had US CPI, which is the official inflation rate of the United States, being released. And then we've had a couple of other, interesting news about companies doing, buys and sells and those types of things. So it's real interesting to see how things are taking off.
Yeah, and last week we were talking about the typical volatility that we see in September and October leading up to the presidential election in the United States every 4 years on this election year cycle. So, all the volatility, right? We talked about that. We're expecting to see more of that. But one thing that's special in this upcoming week is that the Federal Reserve, right? The Federal Open Market Committee, the FOMC, of which Jerome Powell is the chairman right now. They're going to be meeting next week, and we might see our first rate cut, right? In a long time. Maybe.
Yes.
Maybe.
Well, I think we're going to get a rate cut. It's just the level of argument and debate right now is how much of a rate cut. Is it 1/4%? Or in our vernacular, 25 basis points, which is 1/4%, or 0.5%, maybe 50 basis points. That's a bigger move. It would be, and I think the market's reaction would be dependent upon how they put that narrative out there. For example, if they say, hey, we just want to get ahead of any weakness in the labor market. It's already softening quite a bit from a pretty tight level. We see economic activity coming down a little bit. We just want to get ahead, so that gives us a little more wiggle room so we can be more patient. If they give 0.5% and then combine that with that type of explanation, I think the markets will be fine with it. But if they do 0.5% and then don't provide any realistic explanation, then that's going to be a real problem, because what it indicates and it signals to the investors in the world are the Federal Reserve thinks that the economy is falling apart faster than we think. And so then they'll react pretty negatively, and equities will sell off and bonds will probably rally.
So the markets, and this has been interesting, just like so fascinating to watch to me over the last 2 years, even, is that the market has almost reacted opposite to what we would expect at like every Fed meeting, to where, like, we know, quote unquote, no. And you actually have a chart that shows like the probabilities, right? So the future casting of like, what's the biggest probability of what's likely to happen at this Fed meeting, which tends to be pretty close, right? So we have these like so many analysts, so many people predicting the same thing. That thing happens, and then the market freaks out anyway.
Yeah.
Right? That happened over and over the last couple of years. So I'm curious as to your prediction. What happens if there's no rate cut? What happens if there's 25 basis points or 1/4%, and then you just explained, 0.5%? What might we see in each of those cases?
Okay. So in those three different scenarios, so if we get no rate cut this meeting, equities will sell off. Okay, they'll sell off. How aggressively depends on their commentary around that no rate cut, because it would be really surprising. And I'll explain a little bit why that is, as the podcast goes on. If we get a 25 basis point or a quarter of a percent decrease, that's what's baked into the markets right now. And that's going to be a kind of a non-event. That's as expected. So it really then depends on what's the commentary around the next move, or what we call the dot plot, where all of the members of the Federal Open Market Committee give their individual forecasts of how interest rates are going to move over the next 12 months. So, they put little dots to where they think those interest rates are going, on each meeting. And that dot plot kind of gives you a generalized path of the interest rates over the next 12 months. If they do a 0.5%, it's going to be very, very important for that commentary to be supportive of, hey, inflation's coming down. We are very comfortable it's going to be in our target range really soon. And so we feel comfortable getting ahead of the curve since monetary tightening has been taking place. So the commentary with all of those is really pretty substantial because it gives us a forecast into what are the committee members thinking, what is their expectation for the future of interest rates, and that is what determines the value of all investments, whether it's stocks, bonds, real estate, commodities, and the like.
Okay, so the biggest thing that the Fed is looking at right now, right, is inflation. Jobs also, but we talked about this last week, the job survey, job openings and losses,
And labor turnover
labor
survey.
turnover survey. There we go, the JOLT survey. I'm gonna remember that whole acronym sometime. The JOLT survey. So we saw that that was softening, right? So that's a clue to the Fed. Okay, we might be able to lower interest rates. And then inflation data, we just got some new numbers for that, right? And that's what we're going to talk about more today. That is also looking supportive of the ability to cut the rate.
Yes. The US CPI, the Consumer Price Index for the average urban consumer, was released this week, and the headline number was 2.5% over the last 12 months. So again, not very far away from their average target of 2%. The Fed wants to see it get down to 2%, and at 2.5, it's on its way there. Now, to be fair, it has kind of based out here. It's been 2.5%, for a bit, and it's not coming down as fast as I think certain members would like to see. The core inflation, which is the CPI, okay, which again, the CPI is just a basket of goods and services that the average urban consumer would use and consume. All right, so it's this basket, and they track that same basket over time to see the changes in price levels. Couple of things that they do with this statistic, and I'm going to really get a little wonky here. Certain components within the CPI, they average over a long period of time. So the average, so your experience may be different in your locale, for certain items. Okay.
Mhm.
You know, gasoline is probably a really important part, right? But gas in New York, gas in California, very different than gas in Arizona and Ohio.
Yeah.
So very different in prices. So those are local differences. But again, this gives you a broad average. So the core, which what they do is they take that CPI basket and they subtract out energy costs, okay, which also include gasoline, and also food prices. Now, why would you get rid of energy and food prices when seemingly that's what we spend a lot of time, a lot of our transactions buying stuff is in the grocery store, restaurants. We're buying food, right?
Right.
And gasoline. Um, the reason they do that is because food prices and energy prices are extremely volatile. Um, and it may not be indicative of the actual underlying inflation trend. I'll give you an example. One of the very famous um, products that people are talking about food inflation is the price of eggs. The price of eggs have gone up very much. They've basically doubled.
Mhm.
Um, and people are thinking that's underlying inflation. Well, it's not really. What it's more due to is the avian flu that got embedded um in our chicken farms, and they had to cull or eliminate all of the hens that had avian flu. So when you go and you cull that group by so much, what happens? Well, your egg production goes down because you have fewer hens. So what happens is you have to, have chicks that are little, then they grow up into hens, and then they start laying eggs. And so that rotation has yet to it's taking place, but the chicks are just growing. So the supply of eggs has been constrained significantly over the past year or two, and now we're to the point where we should start to see some more supply coming on the market, and that should drive prices down. But again, that's a very idiosyncratic issue, right, with eggs, but those are in food. And so you have a lot of those types of issues when it comes to food and energy costs. So if you strip that out, it can give economists a better idea of what the actual overall inflation pressure is in the economy. So they've created this index called the core index. And it was about 3.2% year over year. Still not very elevated. Okay. It's come down quite a bit, but it's still positive. So again, there's still some of this inflation. So in analyzing the different kind of big categories, I'm going to share a great graphic um, from Yahoo Finance, which the BLS put together, the Bureau of Labor Statistics. And so I'll walk you through this, everybody, verbally, but essentially it says where the inflation is or isn't. And it gives you all these different categories on the vertical line. And then it gives you a bar chart showing over the past 12 months in August, where was inflation? What was pressuring it to go up? Auto insurance was up 16.5%. Auto insurance.
A lot.
Yeah, it's a lot. And a lot of people have been, I see that on social media. I see it in the financial media. Um, auto premiums have gone up substantially. Next two are rent and housing.
Well, I want
Those,
to, before you
Mhm.
go too
Yep,
far
go
there,
ahead.
I want to mention that auto insurance at 16.5%. So if anyone who's looking, watching on YouTube, it is far and away higher than anything else. That 16 and a
Yes.
half is like the bar chart is just huge compared to the next one is 5%.
Yeah.
And
Yeah.
then it's a little more gradual from there. So
Yeah.
go
The
on.
second category is rent, and that's gone up 5% year over year. So again, still a healthy clip above 2% with rent, but still far, far below the auto industry now, or the auto insurance. Now, auto insurance also makes up a smaller component of CPI than rent and housing. So the main pressures for this month were auto insurance, rent, and housing. Okay, because rent and housing combine together to be called shelter inflation, and shelter inflation has basically been one of the key points to keep inflation elevated above the 2% target. Now, auto insurance. Let me talk a little bit of idiosyncratic why I don't think auto insurance is a big deal, and why it should probably be coming down. Um, Auto insurance premiums. So when you're an auto company, and you have you insure someone's car, and that person gets in a wreck, they have to fix it within certain realms. They have to fix it, and so the more valuable used cars are, the more expensive they are to fix.
Mm-hmm.
So what happened is, and I'm showing you now this next chart, which is the Manheim Used Vehicle Value Index. And I think everybody, if you remember back to 2020, 2021, and 22, when we had that supply crunch, used car values spiked tremendously. In
Yeah.
fact, in the chart, you're looking at from a January 2020, you're looking at an index level of about 130, and it peaked in about December of 21 at about 250. So you had a significant 40% growth there within a very short period of time because of the supply chain being backed up. Now, what I can tell you is that index from that peak in the end of 21, early 22, it has fallen pretty substantially till last month. It has not come back to pre-pandemic levels yet, but it looks like it's on its way, okay, or at least somewhat on its way. Now, as the vehicles drop in value, the insurance companies, now their insured losses are going to probably be less, as because the cost of fixing those cars is less. And so again, it's going to be delayed by quite a bit, but a year or two. But auto insurance premiums should moderate in the future based on that index. Um, so that's I just don't think that's a big deal. In fact, as you look at this graphic where I was showing you the different categories of inflation year over year through August, used vehicles were also the most that have come down in price, 10.4% over the past 12 months. So again, it's just delayed. Auto insurance is delayed. It's a lagging indicator of used car values. And so you're going to see that moderate. So it's not that big of a concern necessarily, although over the past 12 months it was.
Mm-hmm.
But in the future, it should, again, like I say, moderate, and that inflation rate should come away. The really the biggest is shelter. Shelter has been persistently strong, ever since really 2020,
Mm-hmm.
when real estate values took off, um, and they've remained very, very high since that time. Everybody, a lot of the economists and analysts for that area talk about it being a supply constrained,
Right.
meaning we need more units, we need more houses built, we need more apartments built, we need something built where people can buy on an entry level and establish families, establish independent households. Um, and there's just a dearth of those type of properties out there. One, mortgage rates are pretty high for new buyers, and two, there just isn't that many affordable homes for entry level buyers or the next step up. There's lots of really expensive homes out there, but for an average family of four, probably outside the price range.
Well,
Um, go
before you
ahead.
go, yeah, too far ahead on that one, it's been super, super interesting to see exactly what you're saying, like in real time and looking for homes. And when we talk about the supply issue, what's so interesting is that even the things that are being built, um, one of the areas that we're looking at moving, like there's a lot of they're like townhomes, but not. They're like very small homes. They're kind of like townhomes, but they're just, little tiny yard, you got a garage, small house, maybe 1 to 2 bedrooms, and they're only for rent. They're being built
Yep.
as rental units. And it's a whole, little development of them, very cute little homes, but they're rentals. They're not being built for sale. And then on the other side, there's also a lot of apartment buildings, luxury apartment buildings being built, which again also come with a pretty hefty price tag compared to, right? It's not certainly not trying to be on the affordable housing side. Um, on the other side, I've seen patio, they're called patio homes, right? They're typically 55 plus communities, that kind of thing, smaller homes, two-bedroom homes, but they're still in the, three to $400,000 range.
Right.
There's not anywhere I've looked in, and admittedly, bigger city areas. I'm not looking, in rural Indiana or rural Idaho, like I'm not looking there. But to get a four-bedroom home around a major city, I literally haven't seen anything for less than 550. And
Oh yeah.
like you're saying, and those are homes that are not in very good shape for the most part, and it's looking at more like 900, a million. And then when you get to like 1.3 to 1.5 million, those homes were literally selling for 5 or 600 less than 10 years ago
Yeah.
that are now selling for 1.5 million.
Yeah.
And so it's very interesting, and I've mentioned that before, partly because it's part of my reality right now, right? That I'm looking at stuff. But the affordable part, when my husband and I were younger, our first home that we bought was $75,000. Wasn't in a good part of town. It was a little rough. But it was a really cute house, a historic home. It was $75,000, had 3 bedrooms that were little, um, but good, right? Like, it was solid. Our next home that we bought was 162,000 needed work, in Mesa, Arizona. That one's actually a really good example because we paid 162.5 in 2015 for that home. Did a lot of work to it, had 3 bedrooms, decent amount of space, nice backyard, all of that, but we really did a lot of improvements in that home. We sold it for about 245 several years later, 245,000. And then now when you look at Zillow, it has not been improved, there's nothing better about it, but it's worth about 450.
Yeah.
And I cannot for the life of me imagine, like, this house that I sold for 245 is now worth 450 with 0 improvement at all.
Yeah.
It
Yeah.
hasn't
And real
it's in
estate
worse shape.
degrades. Yeah, it's in worse shape because it degrades over time. I mean, that's one thing about real estate is you can't just own it and not do anything to it. You have to actively manage it. Otherwise, it degrades.
Mhm.
And you may be able to sell it for a lot, but there's a lot of decay in those homes. So um yeah, it's an interesting dynamic. So I've talked to executives at some of the home builders, and it comes down to their inability to find projects that they can do and get out of those projects profitably. And one of the biggest constraints has been the availability and cost of funding.
Mhm.
Uh, Banks used to finance a lot of these developments where they would go in, a developer would go in, they say, okay, I'm going to put in this neighborhood of 100 homes, and we're gonna develop it over time, and you give me a loan for the full amount, and then you disperse it to my account as I need it. Okay, that's a construction loan, right? A development loan. um and due to the great financial crisis and the real estate bust that happened around those times, a lot of banks got out of basically doing development and construction loans. And so where has it gone to? It's gone to private lenders like credit funds, like which are basically hedge funds that loan money to people that are doing real estate or people that are running businesses, but their cost of financing is much higher. They're much higher than banks because their cost of financing, the hedge fund, they take in money from investors, and those investors they have a rate of return requirement, and they want to make money. They're not doing it just to, just to get development going. They're doing it so they earn money. So the cost of funds is very, very high in those areas. Um, and I think it's one of the things that um, has constrained new entry level homes.
Mhm.
Because if you're a developer and you have now these higher costs of funding, you have to be assured that you're going to be able to sell all of these homes at a pretty decent profit margin. Well, if you're not going to make any profit until, let's say, you sell them in four tranches or four parts of the development. Phase one, you're losing money. You're just recouping. Phase two and three, you're also recouping money. Phase four is when you make all your profit. Well, if you're not really sure that you can sell for a profit those phase four units, you're not going to do the deal. And because the cost of financing has increased that so much, it does constrain home builders from building small homes, because small homes have small profits
Yeah.
and big homes have big profits. Um, just as in terms of dollar, if you're going to make 10% on each home, right? 10% on 100 grand is 10 grand. 10% on a million is 100 grand. So
Right.
that volume becomes a very big deal. Um, so it'll be interesting to see what happens. But I think the mechanism which has broken the entry level real estate market has been tightening so much the type of loans that banks have historically, but now currently don't do, the development loans and the construction loans.
It's so interesting, to hear that perspective, because I mean, I see it here too. Right now, I live in the Cincinnati, Ohio area, kind of north of Cincinnati a little bit. And there's plenty of land, right? There's lots of space to build. But any of the newer developments that are being built, they are typically, starting from 350,000 or starting in the 400s. What does starting mean? That means that's the smallest house that they build.
Base model.
Yeah, their base model with no upgrades, anything, so if you want anything nicer or, more bedrooms, it's going to be 450, 500, 600, 1,000 in these neighborhoods. And that's pretty much any development that I've driven through or driven past, right? Almost every sign is about the same. Um, I have a client in Colorado, that was looking like, oh, here's a new housing development. It was about the same, 550, 600. Um, and not small homes either, right? The same, 4,000, maybe 3,000 to 4,000 square foot homes, which are, which are big to anywhere else in the world. And in America, we're still like, well, that's fine. That's normal. You
Yeah,
go to Europe, they're like, why do you need that much space?
exactly.
But so yeah, so that's really interesting. And I am really curious to see how that plays out over the long haul. What that looks like if we're able to build, homes that are smaller, if the starter market is ever going to come back, starter home market, um, and I know a lot of my family lives in the Phoenix area, and it's like the places that are left to build are, it's getting further and further away from the city centers. And so people would go out to those Marana or Santan Valley, which is a good, 30, 40 minutes away, even from,
The edge of
downtown.
civilization.
Right. Yeah. If you need to go into Phoenix or Scottsdale for any reason, you've got more than an hour drive. But that's where people could get those affordable homes, right? That were in the 200s rather than the 400s. Um, so yeah, it's interesting to see where that'll go and what that's gonna do to the housing market over the next decade, really.
Yeah, and I think it has to be legislative relief. I mean, you have to, I mean, legislation is what put this problem in place,
Mm,
right? The regulators tightened up so much on banks because of the mortgage issue, right? And so they tightened so much on banks that banks are like, we're not taking hardly any risk in our loan portfolio um, because we don't want to get pilloried in the press for everybody to hate us. Because if you think about it, in 2007, 8, 9, 10, banks were the most hated industry in the media. Okay.
mhm,
And so it's a big problem. So we've gotten what we wanted, which is banks taking less risk. Problem is the unintended consequence is now developers and builders have much higher cost of funding, and they can't make money on smaller deals. And so
mm.
how do you fix that? Do you open up the regulations again and say, okay, banks, you can have for a certain percentage of your capital, you can loan these type of loans, open it back up to developers and construction loans. They are more risky. Okay. They just are. Um, I don't know.
Could that also come from, like, Fannie Mae, Freddie Mac,
Sure.
that
Absolutely.
that I mean, they give out a lot of home loans, right? That's what they're there for. That would be an interesting policy to see,
Yeah.
maybe, right? If this is one of the core issues that we're dealing with now as a result, and I remember exactly what you're talking about, right? With the was it Frank Dodd? Dodd-Frank regulations back then, like, that just, okay, you have to have this much capitalization, you have to have this much money on hand to back up this much of a loan portfolio, right? So in a bank situation, the way a bank makes money is that they take in deposits from depositors and then they lend that right back out, right? And so the loan portfolio is going to earn the bank more money than they're paying out on the interest and the checking and savings accounts, right? Um, I've mentioned this on the podcast before. My first job was at a bank, a small local community bank, and we had to go into the vault. We had to put the money in the vault every day, right, when we're closing and all of that. There was not, $10 million in that vault. There was some money in the vault. It wasn't a lot of money. So it's not, it really is true that, like, the balance is not in cash for
No,
the
no.
small bank to be able to be like, okay, if anyone needs their money back, we have all of it here for you, right? Because it's
Well,
lent out.
yeah. Well, I mean, if it's one or two depositors that want all their money, that's fine. You can cover that. But if everybody shows up at once, that's what we call a run on the bank, and that's how banks go out of business. Um,
Yeah,
you know,
and
if you're,
that bank, the bank that I worked at, back in 2007, they did get shut down by the FDIC and
oh,
through and they everything looked fine on paper until they tightened the restrictions, and then it was like, "Nope, this isn't good enough." So they were actually consolidated under, I think it was SunTrust Bank, out of California, that took them over. I wasn't there anymore at the time, but it was really, really, like, surprising, for that to have happened, but it was, it makes sense how that regulation over these, what is that, 14, 16 years now, has we're starting to really, like, understand. It's not see, we were feeling the effects already, but we're starting to understand, okay, what's the actual problem? What's the issue we're dealing with, and how are we gonna fix it?
right. Because most contractors, most developers are not the large public companies. So we have to understand that these are not the Pulte's of the world, the Lennars, the KB homes, those are very few and far between. Those are definitely the larger of all of them, which is why you see more of them now, because they're the ones that can actually access financing. But the small developer, which does, in my mind, most of the development around the country, are the groups of people that get together, form a company or a partnership, and say, we're going to develop this property together, and we need to get some funding, and we're going to kick in a little of our own cash, but we're going to try to get financing. And generally that was through a bank, but now it's not. Now it is, you have to go to alternative sources of financing, which are more costly and more prohibitive. And so you have to be very, very moneyed or very high net worth or substantial assets to pledge to be able to gain those financings and earn those profits. So I think it's solvable, but I think the real backlog for the supply, at least for the lower cost housing, the entry level housing supply, is the cost of financing and the availability of financing. So I may be, I'm definitely continuing to research this area, because I think it's a massive area of issue that will be continuing to be an issue, not just in the presidential election this year, but also for the next few years, as we have this deficit built up of people wanting homes and none being available, which
Mhm.
has kept the price sky high.
Yeah. Oh, so interesting. Um, and that also why I've heard so many, realtors and people who follow the real estate market say that this isn't a bubble. It's not a bubble like in 2008, where home prices at that time in some areas, home prices had doubled over the last 4 years then as well,
Yep.
but that wasn't supported by fundamentals. It was right, it was because of the risky loans that were being given out. Whereas
Yeah,
this is supported by, no, there's actually like a restriction of supply across the nation.
exactly. Had we been having a number of more homes being built, I think the prices would have already normally corrected. Um, Not to say that they would correct that much, but there would at least be the rate of increase would have been much slower
Yeah.
than it has been. So it's, um, I've got a son who's married, I've got a daughter who's married, and they're, and they're looking for homes, and it is very, very difficult unless you have two very successful individuals. It's very difficult to afford a home.
Yeah. Well, we'll see. There's next week we're going to talk about some of the policy, um what do I want to call those? Some of the policies that are being put forward from the different campaigns, from Harris campaign, from the Trump campaign. One of which is, Kamala Harris has said she wants to have a $25,000, down payment assistance for first time homebuyers, um, which would be wonderful. And at the same time, it's kind of like, oh, that'd be nice for other home buyers as well that are actually kind of stuck because of the way the housing market has gone. If you're moving, you have to move for a job, for example. You know, some people don't actually, if they sell their home, it's still not enough for the down payment on their next home.
Right,
Depending
depending
on
on where you're
what,
moving.
yeah, if you're moving to a higher cost of living area. If you're going to a lower cost of living area, it's great. It can work out really well. But yeah, so that's one policy that has been put forward for consideration. So we'll talk a little bit about those next week, and what that might look like. And we'll also have that decision from the FOMC that's happening September 18th. We'll find out. Are we getting no rate cut? Are we getting a 1/4%? Are we getting 0.5%? And how's the market going to react? We should have all that data next time. Um, so yeah, we'll see. The wheel keeps
Very
turning.
excited about that. I mean, we've been in this higher interest rate environment now for a while.
Mhm.
So again, if you have a bunch of cash, great. You've had a great money market or cash return over the past couple of years. But lock it up in the higher yield if you can, or higher yielding instruments if you can, because those days are going to be probably going away for at
Mhm.
least a little bit.
Yep. And while this is absolutely not any investment recommendation of any sort, right? This is also, as we've talked about before, when it's volatile, when kind of feels bad, um, to be in the market, that could be a really good time to get in if you have cash on the sidelines. So that is something that you should absolutely talk to your financial advisor about and make the smartest decision for you and for your needs, for your short-term, long-term, midterm needs. All of those things need to be considered. But when we're seeing the volatility that we're in right now and that we expect over the next couple of months, um, yeah, it's not a bad thing if you have a long time horizon. So
Exactly.
always beat that drum.
Absolutely. Absolutely.
Well, thank you, Brad, for being here today. As always, if you have any questions, anything percolating for you, if there's a policy that you've heard about from either one of the candidates that you want to hear us talk more about, happy to dig in. And Brad loves research, right? Brad, just give you a
I
research
do.
project and he's like all over it. So I also enjoy research, but I think you like it even more than I do. So send Brad your questions. And Brad, how can they get a hold of you?
You can email me at bhaines, BHAINES, at juncturewealth.com, or you can give my office a call at 480-253-4100.
And as always, you can get me at Hannah, HANNAH, at expansiveceo.com for any podcast thoughts, questions. If anything resonates for you, I always love to hear your feedback. So thank you, Brad. We will see you next time. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.